Hello, my name is Etienne Viljoen. Stocks began the year at fairly stretched valuations, especially the tech-heavy US market. Inflation then started re-emerging for the first time in almost a decade. After that, the Fed needed to raise interest rates, especially with the ongoing war in the Ukraine. This, coupled with China's zero-COVID policy, put enormous pressure on the whole world and led to a disastrous 2022. There's definitely been a deterioration in financial conditions and activity. According to the latest IMF survey, global GDP should grow by 2.9% in 2023, down by 0.5% from 2022. US, Europe and China is expected to grow below their 10-year averages, with the bulk of the growth expected to come from China and the emerging world. European and emerging markets should outperform the US this year. One risk remaining to Europe is its energy dependence, but that should be strongly offset by strong capital inflows into their sovereign bonds. The US Fed will continue to play a balancing act between inflation and employment, which should make the dollar weaken gradually during the year. This in turn will be very good for emerging markets and commodities prices. Inflation and concern about global food and energy supplies ranks amongst the top risks. One will also have to keep a close eye on the ongoing war in the Ukraine, as well as possible changes to China's zero-COVID policy. Abundant capital lifted the value of all assets during the past decade. This, however, is changing, as investors will move scarcer capital towards assets with the best outlook. Because capital is not free, a preference will be given to shares with a good track record of growing earnings. Less central bank intervention should also be good for policy certainty as we move back to a more normal investment environment. This should also be good for active investing, where active alpha should be created by investing in long-term economic trends.